Thank you all for coming today. This is our second Cyber Risk Wednesdays presented by Zurich Insurance. We're very happy to have some great presentations today, and we'll follow that with a moderated question and answer panel. If you're following online, please use hashtag Cyber Wednesdays, one word. We're going to be having active participation online, and we'll be asking your questions to our panelists here live. So please participate in that. Cyber Risk Wednesdays is part of a larger project called the Global Aggregation of Cyber Risk that Zurich Insurance is partnering with the Atlantic Council. My name is Jason Thielen. I'm the Associate Director of the Cyber Statecraft Initiative here at the Atlantic Council. I work with Jay Healy, who's our director, and we've been working with Zurich for about half a year now. We're about halfway through a year-long project looking at systemic cyber risk, going beyond our traditional or conventional cyber threats that you see, looking beyond what you're going to see 5, 10 years down the road to understand how cascading concentrations of risk can affect an entire sector. In that vein, we've been working with Zurich to look at a global view of this problem, going to different regions in Asia, Europe, even Latin America, to get a global understanding for how these risks can cascade in ways that we're unaware of. Today, our Cyber Risk Wednesday will be focused on cyber insurance. We're very happy to have Tom Bossert, Matt McCabe, Catherine Mulligan, and Greg Rattray, who are going to be working us through this problem and understanding how risk transfer options like cyber insurance can be used to address and help answer some of these issues that we see. We're going to start with a presentation from Catherine Mulligan, followed by Matt McCabe, and finally Tom Bossert. Catherine comes to us from Zurich Insurance, where she's the Senior Vice President for Zurich North America, working on National Underwriting Manager and working on specialty products and errors and omissions coverage. With that, I'd like to welcome Catherine to the stage.
Thank you. Good afternoon, everyone. It's really nice to be here. Do we have slides going, Jason, or just click the... my technology background showing here. Here we go. Thank you all very much. So today, just to level set sort of the world of insurance for security and privacy liability, or cyber, I thought we would talk about some of the results of this Advisen survey that has been happening for the last 3 years. Advisen is an outfit that does research on insurance issues, including this one. So for the last 3 years, Advisen's been asking risk managers about your understanding of risk and how do you make decisions around risk transfer, and do you buy insurance for this? What are your concerns about emerging exposures? So what we're starting to see now after 3 years is some emerging trends. Just to level set, the majority of the respondents, of over 80%, are risk managers, either the head risk manager or in the risk manager department, and most had 20 plus years experience. So pretty experienced bunch. The industries ranged all over, so is government, healthcare, professional services, utilities, education, telecom. Kind of interesting that these are some industry segments that we see the highest penetration of insurance in cyber. And so the survey, it really helps us as an industry understand where additional education would come in handy, where information could help risk managers make decisions about how to manage their risk, whether to buy insurance or how much. And also, we can start thinking about new products or how to expand what's available in the marketplace now. If there's any risk managers listening, I would just encourage, continue responding to this survey, because the more information we have, the better the result. So we started with the perceptions of risk. The vast majority of respondents, 89%, believe that cyber and information security risks pose at least a moderate threat to their organization. So one thing that was interesting was last year's report had noted that while the perception of risk, it was basically unchanged for the risk managers. They thought that it was important, but there was a gap between their C-suite and how the C-suite and the board of directors viewed the exposure. That gap closed this year, where the C-suite started to say, yeah, we're with you. This is a concern for us. You see on the right-hand side that the suppliers and customers have, perhaps a different perception than the boards and the C-suites. So there is this closing gap between the risk managers and the executive level management. The reason that's important from an insurance standpoint is in terms of the decision to buy insurance, there's often a multi-part process where all of those stakeholders are involved. So I will note that one issue here was the size of the companies. Larger companies tended to say, we feel that this is a significant exposure, where the smaller companies, under 250 million in revenues and fewer than 100 employees, they were less concerned. Now, that's interesting to note, because if you look at other data from, for example, the Verizon data breach report, smaller companies are actually shown to be subject to quite a few of the breaches. So the perception is that they're immune, but the data shows that they're in fact not. So when a data breach does occur, research suggests that organizations who have a plan and can respond to the situation fare much better financially, reputationally, and operationally, much better than those who don't have a plan. So this is an area where I would say over the 3 years, the respondents have increased their awareness. 72% of the risk managers said that they have a plan, which is good. That's an increase from prior years. But I will say there's still room for improvement. 10% said that they didn't have a plan, and 18% said they didn't know. So we still have some work to do as an industry. I think the insurance industry can help risk managers understand the exposure and building the plan. The slide shows all the stakeholders that can be involved in building a plan. So whether it's IT, general counsel, risk management, of course, compliance, maybe the chief privacy officer. So IT is still the most popular. When the risk managers say who's responsible for the breach, they usually look to IT. I will note that 13% of the risk managers say they're not sure who should be involved. So again, just that education piece of helping companies understand how to put together a plan, which stakeholders to bring in. I think we'll see today when we discuss the issues, we'll see that the scope is quite broad. It's not just an IT issue. So we often will not limit ourselves to saying that this is a cyber issue. We do say security and privacy liability, because it's not just an IT concern. I'll also say, in terms of having these plans, it's really important to test these on a regular basis. You don't want a breach to be the first time that you're testing one of these out. So again, in terms of who's responsible for risk management, by a wide margin, IT is still considered sort of that frontline defense against information losses and other cyber liability risks. So 75% of risk managers think that IT is responsible, followed by 9% is the distant second there, the risk managers. But you'll see the other departments that are kind of represented: treasurer, general counsel, audit, HR. So again, what we would say is that it's important to build a culture of awareness around these issues, and really that it should be embedded into the management and to the culture of the whole company. So that multidisciplinary approach, it allows to have a broader scope of responsibilities to achieve that kind of culture of awareness. So there's lots of emerging issues on this topic, and the survey did touch upon a few of those. Starting with social media. Media liability is sort of the often forgotten segment of this insurance coverage. Some of that is built into the policy. And so we asked risk managers, does your organization have a written social media policy? And it stayed consistent with last year. 79% of them said, yes, we have a policy. Social media can provide a lot of great things for companies, increase brand awareness, for example. But there are areas where this can pose reputational damage risks, privacy issues, data breaches do occur in the social media space. So we would just encourage this continued thoughtfulness on the part of risk managers on this topic. Mobile devices. So more and more companies are allowing employees to bring their own device to work, and there's certainly the benefit of increased efficiencies of traveling employees, for example, but you're accessing company proprietary data on your own device, so that creates a greater risk. 49% of the respondents said, yes, we do allow for bring your own devices. And that's a 13-point increase over last year. So we see that this is the trend. The other interesting thing was in terms of the size of the companies. In prior years, it was really only larger companies that said they allowed this. And we saw a big jump in the companies who were smaller, fewer than 500 million in revenue, said they allow this. The good news was that 72% of the companies who said, yes, we have a bring your own device policy, they said that they do have policies and procedures for their employees to follow. So that was a good thing to see that those numbers are still tracking with the increase. And then lastly, cloud computing. Certainly outsourcing has lots of advantages, the increased bandwidth, there's cost effectiveness built in there, but warehousing proprietary information with a third party obviously increases the exposure there. But the benefits appear to outweigh the risk from a risk manager standpoint, where 55% of them say we do use some sort of cloud computing services. And the good news was, too, this made my underwriter's heart happy, that 14%, there was a 14% increase in companies who said we're now including the assessment of those cloud service providers in our policies and procedures when we're assessing our exposures and our controls. So that was nice to see that they're asking those questions. So this slide, the survey also asks about insurance buying trends for security and liability. So back in 2011, only 35% of the respondents said that they purchased insurance. So that's it says here the blue line. They're both blue on this slide. But compared to 52% of respondents this year, so you can see the one going up. So more companies are buying the insurance. But here's what to keep in mind. Those who are buying are really in industries that have a high level of personally identifiable information at risk and or are highly regulated. So the technology space, financial institutions, healthcare, retail, and to some degree higher education. These are the industries that are the biggest buyers. And also, Advisen has noted the size of the companies that are buying the insurance. About 60% of the buyers exceed 500 million in revenues, and it kind of breaks down in about 19 and 20% chunks of 20% exceed 5 billion in revenues, 20% are 1 billion to 5 billion, and so forth. So it's still the larger companies who have the means to pay for the risk transfer who are buying it. Of those who don't buy the insurance in this year's survey, 53% said they're looking at it this year. That's consistent with what we see anecdotally at Zurich. We have seen an increase in new buyers, but we've also seen probably a 20% increase in buying increased limits. So that's just another trend. So really, this just sets the stage. It's an evolving area. I think we'll see the changes in which industries are buying. We're going to see the different coverages emerging to sort of track with these new exposures, which I think probably Tom, you'll talk a little bit about that today, and Matt will talk about the coverage. So I think, Jason, am I just turning it over then to Matt? Oh, you might need that.
Thank you, Catherine. Let's see. Yep, got that going. We're very happy. Thank you very much for that. Next up, we have Matthew McCabe, who's Senior Vice President in Marsh. I'm going to let you jump right in right there.
Thank you very much.
Thank you.
Good afternoon. So my name is Matt McCabe. I'm from Marsh and previously worked on Capitol Hill and with the Homeland Security Council before that. And I'm currently in the network security and data privacy practice, and my job is going out to the Marsh clients and educating them on what some of their liability exposures might be with regard to network security and the type of data they are retaining, storing, or sharing. and what the liability can be to arise from that. On this first slide, you can see some of the perils or the liabilities that we discussed with them. As Catherine had alluded to, a lot of it arises from regulation about data held, but there's many other types. You can have a legal liability for not only personally identifiable information, but all sorts of confidential information that you might be holding. And in addition to personal identifiable information, protected healthcare information is, of course, a rising field. There was the HIPAA regulation that was passed, decades ago, and then updated with HIPAA High Tech, and then again further modified with the Affordable Care Act. And we are seeing right now, because of the Affordable Care Act, an evolution on how healthcare centers will have to treat and share data. And that is becoming a growing field yet again. Regulatory actions and fines are some of the greatest instigators of legal liability. There are many, many costs that are generated just by an investigation that never leads to a regulatory claim. Sometimes can constitute, from one insurer I spoke to, can constitute 20 to 25% of overall legal liabilities in some cases without a claim ever being filed. There are some, what are often thought of as niche coverages, such as cyber extortion and cyber terrorism. Cyber terrorism there is a great deal of attention to because of the threat, but there has been little recognized claims for that, of course. But cyber extortion is something that, believe it or not, has been growing in an uptick. There's been some ability to capture somebody's data, somebody's system, and hold it for ransom. And usually what will happen is if the price is kept low enough, if the demand is kept low enough, then it becomes a nuisance claim. I believe that there was a hospital that this was accomplished for in the recent past successfully for about $300,000. And there can be coverage that responds to that. If your data is damaged or corrupted, it can pay for the restoration of that data. If there is a data attack and your business operations are interrupted, then you lose revenue and there might be extra expense for restoring your network. The coverage can respond to that. And Catherine had talked about the increasing use of cloud, and I'm not going to go down the rabbit hole of how much the cloud is becoming prominent in aggregation of data, but IT systems are relying on more and more vendors, and therefore you're becoming more and more susceptible to the health and operation of other party systems. So one of the growing coverages right now is that you can purchase a contingent network interruption, and therefore if you are reliant on another network for your operations and that network goes down, then your extra expense can be compensated. And the last one, they talk about loss or damage to reputation. There's no financial number that is put on somebody's reputation, but what this primarily corresponds with are crisis expenses, that if there is a data breach. And there was in Ireland, there was a recent example of a customer loyalty card that they had a disclosure of millions of records of who their loyalty member is. And the thought was, well, why do I want to join a loyalty program as a valued customer if you're going to lose my information and I'm going to suffer a fraud? I'm going to be taken advantage of by somebody committing fraud. So what the insurance really targets as, what do you do in response to a fraud that will reclaim your reputation? So, there's a lot of misnomers about what cyber insurance covers. It's kind of an ambiguous phrase, but I would describe it as it protects the consequences from corruption or damage or breaches of your data or interruptions of your network systems. So on this slide, this is PowerPoint to death, because this is a slide with purely just terms. Sometimes when I'll go into a meeting with clients, I'll actually put a mythical figure of a Hydra in it, and it'll be 7 heads coming at the client. I'll say, you should be scared right now because you can see the cyber attack coming at you. And that's basically so that they can just remember who I was. But you'll see on here some of the many perils that are posed to anybody operating a network system and who is perhaps storing sensitive data. Maybe I'll start on the far right. The longest list is the regulatory regime developing around cybersecurity. Of course, HIPAA and high tech and the FTC's identity red flags and the FTC investigations are well established. I mean, that's nothing that's a field that we're already responding to. What we do have our eye on is the SEC guidance that was issued a couple of years ago, and see if that'll be more prominent on how they're responding to registrants' disclosures about the materiality. I mean, you know, it's a whole other debate about what it means to have a material cyber vulnerability. If you're, and of course, you know, cybersecurity coverage is one thing. For SEC disclosures, that's really going to respond to a different type of insurance called D&O. D&O insurance for directors and officers and how you're making public statements. But it does show the growing attention to cybersecurity and how the government is trying to improve the reporting, the standards, and the practices around cybersecurity. The Department of Homeland Security and the National Institute of Standards and Technology are developing a cyber framework which could serve as a Cyber Wednesday chat all to itself. And I think Jason would appreciate hashtag Cyber Wednesday is something that we should repeat several times. That's just the regulatory column. I mean, so for technology, this is what everybody probably pictures right away when you discuss cybersecurity. There's a multitude of cyber attacks, but it's also important to educate the clients that just for your paper disclosures, if you're not disposing of sensitive records quickly, or properly, I should say, then you could have a data breach violation. And that still exists. And actually, the prominence of that is on the rise. And it's not necessarily because the incidents are more often, but because the compliance regimes are growing and there's more detected incidents of improper data destruction, I suppose is the right term for it. But also, you know, people always think, well, am I vulnerable to a hacker? Well, I always tell them, well, do you have employees? You know, do you have somebody that you might fire and might be a little resentful? Because frequently it can be, well, let's say there are two types of dangers with employees, and they both involve bad decisions. Somebody who's either bitter or careless. So it might be somebody exacting retribution, or it might be somebody just clicking on a link that opens a back door to your network. So I've already talked about this. I won't go on it too much because it's, but this is right here, the full lineup of what we can offer. And as I said, it's extortion, it's interruption, it's data breach coverage. And you should think that if you're storing sensitive data, which can pertain to protected information, personally identifiable information, healthcare information, financial information, or confidentiality. If you have sensitive information about, you know, you're a law firm and have sensitive information about acquisitions, and if there's a data breach over that and you might suffer some liability because of it, then you should look into the possibility of insurance. And we talked about, you know, well, when do you come to that decision of making insurance and how much of an investment is going to be? As Catherine had alluded to, a lot of it's about education. I find that for purchasers are usually the best educated clients, that they are more likely to purchase. I mean, you're making an equation of, well, I have a security budget of, you know, do I spend 1%? Do I spend 5%? Do I spend 10%? What do I vote to insurance versus the technology I'm going to use to protect my systems? And, you know, there's no 100% solution. We've all repeated that enough times. So it should really become part of your risk mitigation. You should be able to best defend yourself, but you should also be counting on that rainy day to come. The origin of this type of insurance is basically that in traditional types of insurance, there were gaps in the policies that weren't responding to data breaches or network security breaches. For the errors and omissions policies, there would traditionally need to be some type of act of negligence, but a data breach might not involve any negligence, and therefore there would be no responding claim to it. For a general liability policy, I mean, this is, you know, really the origin of all this is that somebody had a policy, something happened that they lost information or their network was breached, and then they tried to claim it, and they found out, well, it didn't cover it. So commercial general liability, I mean, I read, I'm going to keep proper names out of it, but recently I read an article by a very educated cybersecurity professional here in DC talking about the limitations of cybersecurity policies. And they were talking about, well, you know, cybersecurity, you got to watch it because they don't respond to notification costs. And you're going to have these crisis management costs that are going to add up quickly, and they're not going to respond to it. And then you don't even know where you are on your legal claims. And I couldn't help but think, boy, this guy, for all his esteemed education, is dead wrong. And what he was talking about was a commercial general liability policy that somebody tried to claim under, but it didn't respond to a cyber breach. For a property policy, there is electronic data is often not considered tangible property. That'll go by jurisdiction, but for those jurisdictions who have ruled that it's not tangible property, the cyber insurance policy will make sure that you have a responding insurance. For crime usually, well, crime involves the theft of securities or theft of money, but not the theft of data. And for kidnap and ransom, a very specialty, if somebody kidnaps you, you would have to kidnap an actual person and not somebody's network system. And I'm sure for the first people who got a kidnap and ransom claim based on my computer's been taken hostage, probably hung up the phone because they didn't know exactly what they were talking about at the time. As that's evolved over history, it's become more prominent. It's not a large part of the claims, but we are seeing it in a very informal conversation with a government agency. They did note to me that there is an uptick in this recently. So this is kind of a slide that when I introduce it to clients, you know, I say, okay, if you're going to remember one thing from me today, remember when you get a data breach, walk through these positions. This is your timeline of a data breach, and this is how you should be responding. And you should have a plan for each one of these actions. And you can see that the discovery of it, you hope you discover it yourself, but usually you don't discover it. There can be a third party or, unfortunately, a government agency who says, hey, do you know that we found this information in such and such a place? There was recently a story about how copiers that had been leased by a healthcare organization for a period of time, the lease came up and they returned them and they forgot to delete the personal data that might have been stored on the copier. So fortunately for them, the reclaiming company alerted them and they were able to mitigate that breach. But if those copiers had just been sold without that check, then they would have been on the hook for a significant healthcare breach. And I did not follow up on the story, but I believe that there was some regulatory follow-up that they did have some expenses for. So the first response, you know, one question about the first response, it's kind of counterintuitive, but a lot of companies say, okay, we've had a breach. What we need to do is get a notice out to the people who might have been affected because there are regulatory requirements. Not always a good idea. The first thing you should do is probably hire an expert consultant and tell you how to do it because you can actually increase your costs by rushing out a notice and getting it wrong. For external issues, public relations, notification, crisis management, credit monitoring, all the things that might be necessary as a result of a breach. And usually this plays up for us very well because if the company is saying, well, we don't have any of those and we don't know how to do that and we don't have a plan for that yet. And that's not every company, as Catherine had said, but if there is a company like that, then solutions can be introduced with the insurance that will provide those services. This is some of what I referred to earlier, but these are some of the aggravating costs and mitigating factors for how your costs are going to go after a data breach. I mean, if you have a chief information security officer who's already running policy before the breach, most likely that's going to mitigate costs in the future. If you rushed out your notice, that is going to greatly increase your costs. If you have lost a laptop or if you've lost a personal device that has data on it, that's going to be an aggravating factor in the costs after it. But I will say, from my experience, I think Catherine would probably be better to speak to, is the most likely aggravating factor is going to be the amount of liability and whether this comes to litigation. This is a slide that is too minute in its writing to really go over here, but it goes through what some of the costs and how they build up very quickly. To read some of it off for you, there's notification costs, there's costs for a call center to alert people who might have been affected by the breach. Credit monitoring is a cost. Identity theft repair if anybody's been affected by the breach. But really the escalation of costs you see down in the bottom is it comes with your fraud liability and your regulatory issues. The legal response is the big money object. And supply chain disruptions is a growing consideration for us, and especially is relevant for cloud considerations. I kind of spoke to that in the beginning, so I won't go through that more clearly. But if you're relying on the cloud and if you're relying on more vendors and you can't live without them, you should think about scheduling them in your insurance in case of potential disruptions. And this I will give all attribution, so nobody claims that I'm stealing it in the future. This is based on an article that was written by Paul Rosenzweig, who is certainly well known by a lot of people in this room and probably online, that he traced through 2 recent litigations that dealt with cyber liability, and I just use it as an example for clients that this is kind of a standard. Patco Construction was a fraudulent wire case, and that is obviously a monetary crime. But the bank was ignoring red flags and allowed fraudulent wires to go through for a construction company, and therefore had to pay back that construction company because they were not following their standard of cybersecurity to monitor these red flags. And I believe that the contract contained a reference to the Uniform Commercial Code that the court used as its standard. And Lone Star for Heartland Payment Systems, I mean, this is the data breach case. It's cited over and over again as kind of what can happen to you if you're holding a lot of records and not being careful. And I would say Heartland Payment Systems is the #1 example of if you're holding sensitive data, then you should really consider insurance as part of your risk mitigation tools. And I've spoken about this, I won't go on more with this, but we are giving more and more consideration about industrial control systems and SCADA security breaches. This is especially growing in relevance with the development of the cybersecurity framework that is targeting critical infrastructure. Targeting is a bad word. That is focused on improving the cybersecurity practices and standards for critical infrastructure. I recently had a conversation with a security professional who works for a utility, and you see a lot of reporting about weaknesses in SCADA systems, and somebody will disclose to them, we found this vulnerability, or you'll see there was recently a report of 25 vulnerabilities disclosed in DNP3 SCADA protocols. Does anybody double check? Okay, since nobody here is double checking my anagrams, I can swear that that's right. And his comment to me was that, yeah, I saw that, and quite frankly, I've got about a zillion weaknesses in my SCADA system. They're legacy and they're old and we know about it and we don't do anything about it. I mean, these things are built on function. We don't want disruptions. Everybody's aware of that and everybody's accepted the risk of those weaknesses because the systems are operating. And I was kind of taken aback by that because it shows that there are weaknesses out there that can be exploited. And someday that could come to a bad consequence, but I think what we'll see growing much quicker than that is a regulatory environment, perhaps based around the recommendations introduced by the cybersecurity framework that are going to compel companies to address those weaknesses or suffer regulatory liability. This is a slide generated on Homeland Security reporting. It just shows that the energy sector is predominant in this, but it's affecting all sorts of infrastructure, critical infrastructure. And this is, if I'm talking to a critical infrastructure, Trend Microvirus had done a study about just setting up a honeypot test for setting up a bogus infrastructure control system and opening up to the public and seeing what happened. And you see for some of the stats, I mean, within 18 hours of setting up the test, they were attacked. Over 28 days, they registered 39 attacks from 14 different countries. I could read down the entire slide, but why don't I just leave you with the final point that they drew, I guess they drew attacks like flies on honey. I guess that's why they call it the honeypot test. But I just think that it shows you that the attackers are out there, and some of them have malevolent intent, or some of them are just trying to see what their skills can do, or maybe they're just doing a tryout for whatever their approach is. And that concludes it. I guess we'll turn it over to Jason.
Thank you, Matt, very much. Next up, we have Tom Bossert, who was the Deputy Assistant for President Bush and worked on issues of Homeland Security, counterterrorism, continuity of operations, and worked on policy, U.S. Homeland Security, and counterintelligence. So with that, welcome Tom Bossert.
Thank you. I have the distinct pleasure here of telling you that I was not that author in Washington that got it all wrong that Matt read. And I'm happy to say that. I write things that I know I get wrong all the time. Let me see if I can get the slides going. I have too many slides to cover. And what I'm going to do is hold you hostage for the next 25 to 30 minutes as I go tediously through each one. And let's see. Instead, joking aside, I couldn't be any more honored to be here associated with the Atlantic Council and Brent Scowcroft and Jay Healy and Jason Thielen and with Zurich. And I think it's been a really interesting Zurich experience. Martin Sen of Zurich has kind of given personal attention to us. We've been at all these different events. We've met Catherine and her colleagues in Louisiana, and we had a lot of fun talking about cyber insurance. And then we had a lot of fun in Louisiana. And we've traveled the world hearing issues. And I think one thing that we'll hear today is a U.S.-centric focus. But I'd be remiss if I didn't tell you that there is an uneven field around the globe. These issues that we see in the United States are repeating themselves elsewhere, sometimes at a staggered pace behind us. In other places, they're happening in front of us, and they're leading the way. I think the Heartland case that Matt spoke about was probably a great example in the United States. But the recent Sony case that people know of led to the British authorities telling Sony that it just wasn't good enough what they did. They actually cited and held against Sony that they were Sony and that they were, in fact, a technology company that could have and should have done better. It'd be interesting to know whether they would have applied that standard against others. And so that's still in litigation, but I think there's a global aspect to this that I don't want to lose. But the rest of my remarks will be largely my experiences in the United States. So first, the positive. The positive is that, and we've kind of just presumed this today, that cyber insurance is absolutely critical to anybody's risk management strategy. If you don't transfer some of your potential consequence loss, you're really not doing a good job. Now, that said, there are, I'm sure, some companies that don't have a lot of consequential loss that they're looking at. There might be some very small, but I think that Matt and Catherine will tell you that there are insurance policies that can cover those policies, those needs, those customers at big and small size. And so the positive here is if you don't transfer, you've got an incomplete risk management approach. But that's not the entire sum total of what you should do to manage your risk, and I think the audience here probably knows that, but at risk of maybe boring some of you, the idea here is to go through the other components of what you should do to manage your risk. You don't just transfer your loss potential, you also go through hardening your systems. Here's where I'm going to offer a caution to both sides of the house. Treatment and mitigation. The tech folks that are here that do things to make networks more secure, the encryption folks that are talking about new cutting-edge lightweight encryption technologies and so forth, don't end up falling prey to hubris. There are a number of companies responding to the surveys that Catherine alluded to that seem to cite the fact that they haven't bought insurance yet. They attribute that to the fact that they've got strong systems that can't be hacked. And it's not just insider threats, they're just guilty of hubris. There's nobody out there that can't be penetrated. If there's not, if there is, I'd like to know about them. The second here is a caution to the insurance industry. There is some degree of acceptance of risk that is acceptable. And we all accept some degree of risk. You're crazy if you're a potential customer if you don't first measure that risk before you decide to accept it. Accepting it blindly is a poor strategy or crazy strategy. Accepting it with some open eyes is a good and necessary part of your risk management strategy. But for the insurance companies, they think in terms of, I'll go here, replace likelihood with probability. Insurance companies and rate setters tend to think about probability. And I'm not sure how close we are yet in the cyber field. It's not entirely new, but it's relatively new compared to some other lines of insurance. The policy wonks here in Washington, D.C. talk about risk as a function of vulnerability, threat, and consequence. And although many of you have heard this before, I'm going to offer to you my definition of those variables. Vulnerability is technical and human. I agree with my colleagues on that. Consequences are financial losses associated with a disruption of your business or a loss of data or your reputation. Threat, though, is people. Some people debate that with me, and they say it's not just people, it's also their malware and their techniques and their tactics and their procedures. And so the threat is people. There are malefactors of various motivations and degrees of sophistication that are out there intending to cause you harm. There are also errors, and that level of human error I categorize into your vulnerability. But your threat, and take that to mean the driver here, not the error, but the intentional driver, are people. And they're not all criminals. Many of them are criminals. In the United States, we consider them all criminals, except for those exceptions when we have laws that exempt our government officials from being able to do things that we don't permit our private sector to do. Elsewhere in the world, they're not all considered criminals. And I think it's an interesting dynamic. When people want to break the law, they go somewhere else and launch their attack from a country that doesn't consider their practice to be criminal. And so as we move forward, this is the only piece that I'll be on my high horse about today. The government in the United States, at a federal level, needs to do something to address the threat, because the rest of what we talk about is a responsible means of reducing your vulnerability through technical and human workforce practices, encryption practices, hardening practices on the technical side, and transferring on the consequence side. If the government doesn't step in and address the thorny issues of the threat, we're all going to be churning around this for a long time, and I think we're going to have a hard time coming to grips with the new cyber doctrine or the new cyber age. So with that said, let me move past why these definitions are important. It's going to be very difficult for people in a policy-making world to figure out the probability of a future cyber attack. People get stuck on figuring out the probability. Move past the probability and simply define this as the function of vulnerability, threat, and consequence, and we'll have a more informed public debate. So, let me see if I can jump past treatment and mitigation. Here's why. Treatment and mitigation is talked to death. We have tremendous resources at our disposal in the federal government. There are tremendous but costly resources available to the commercial world. They are sexy. They are changing quickly. There is a 2-year cycle on new softwares and new solutions and new technologies. It gets a lot of airtime. So for me, I think we should provide more thought and airtime to the business processes that support why we use the cyber tools that we use and how we use them, as opposed to making them stronger and harder. So here's my pitch for making those business processes a little bit easier to understand and putting them at the forefront of the spotlight, and then not talk about the technical mitigation measures. Reducing consequences, that's why we're here. Cyber insurance. I mentioned earlier that it's important, it's great, there's a positive growth trend. I took some of the advising numbers that Catherine cited earlier. I like these things, they're important. There is no but, I leave you with that, they are important. I will, though, mention that there are classic challenges, and I think it's important to note that they're classic challenges. They're not specific to cyber. I, like Matt, read a lot of people harping on the challenges of cyber insurance, and what I really think they should be talking about is the challenges inherent to all insurance. And so here they are in my most unvarnished speech. Moral hazard. I don't see any evidence of it yet in terms of data. But the concern with moral hazard is that a company buys insurance, limits their exposure, and then proceeds to engage in reckless conduct, exposing their insurance company and themselves to loss. And they do it because, well, what the heck, the insurance company is going to pay for it. I haven't seen that yet. I think the costs of reputation and to the disruption of the executives and so on that accompanies a claim and accompanies a breach are way too great to simply trivially dismiss as a, well, insurance will pay for it type of matter. It might happen, but I haven't seen it yet. Adverse selection, this is something I want to talk about later with the panel. Even today, as I listened to Catherine say that 80% of the respondents to the advising survey were people on the higher end of the risk continuum. My concern, I don't know if I characterize that right, that's that right? My concern is that we might end up insuring the higher risk and not insuring the lower risk. And so this is a kind of a classic adverse selection issue. It's not a problem yet, It's a concern, and I think it's something the insurance companies are very, very aware of. And it immediately, and sometimes people roll their eyes at me, takes people into this underwriting process. It's kind of a mysterious process. People try to figure out how it's done. The bottom line is that for right now, the exposure base and the methodologies behind accurate underwriting are good and sound, but I think they will get more mature. And what I'm calling for is my prediction is I know they will. Because if they don't, this insurance line will probably fail. It'll go out of business. It won't be profitable. And we'll see, hopefully not a post 9/11 type of world where reinsurers walked away from terrorism insurance and we had a kind of a cataclysmic problem that the whole world watched. But I don't think the insurance industry wants to go out of business in these markets. I think they recognize that there's a growth bubble, and I think that they're not trying to grow into that bubble simply for the short-term market share. I think there's a number of good, solid, reputable insurance companies, but I would caution them to develop better and more accurate underwriting procedures that more accurately reflect either correlative or causal cyber risk, as opposed to other proxies like the revenue size and so on. But in the meantime, it seems like they're doing pretty well, and it seems like there's great debate over whether there's enough premiums to cover the data breach costs. There's some people that whisper it's too low, and there's other people that whisper it's too high, and it seems like that's usually where you want to be, right in the middle. So, translating intent into sales. I wanted to look for data instead of giving you my hypothesis on things, and I looked and found in 2012 that this high interest kind of came after a number of big high-profile incidents, I suspect. But this high interest on surveys in cyber insurance wasn't translating into the sale of cyber insurance policies. So I put up some Towers Watson numbers. These things were troubling to me when I looked at them, and I thought, boy, this is as recently as 2012. All these people want insurance, but they're not buying it. I kept looking, and I realized in 2013, all those indicators are going in the other direction. People are translating their intent into sales, their intent to buy into sales. The tail from quote to purchase is shorter. The time from when Matt or Catherine tries to approach a prospective client to when they pull the trigger and buy it is getting shorter. People are showing that this is no longer, I believe, a discretionary investment. It's becoming increasingly a mandatory investment to transfer some of your cyber risk through the purchase of insurance. And just for Matt's sake, I thought instead of citing Towers Watson, I would cite Marsh data, which says the exact same thing, but I think in a much flowerier. And yeah, you should have gone first. Right? For those online, Matt said that he should have gone first. The numbers are the same, and interestingly, almost exactly the same with different survey responders. And so to me, that's a verification. Maybe I'll pause on that slide there, but if the growth is high, don't confuse that with the total percent of insured customers. So we've talked about growth from year to year. We've talked about increasing sales. We've talked about the wonderful growth in cyber insurance. But if I read the numbers from Advising correctly, it's still somewhere around 20% of US companies that are insured. So my next question is, why so low? Is it just because we have to get out and sell more and get people to understand the threat more? I'm not sure. I'm going to leave that for this group and for you online and for anybody else listening in. 20% is not a high number. I started to look for comparative context. Looks like 17 to 18% have D&O coverage. So then I started thinking, wow, cyber's better and bigger than I thought. I don't know what that number should be, but in my mind, in my preconceived mind, we should have more than 20% of US companies insured.
What's D&O?
Directors and officers, thank you. So I don't know what the comparative, maybe Matt will know or Catherine will know in our Q&A session. I'd like to know if that 20% is low, or if we should expect that 50% of US businesses end up with insurance. And if not, why they're all staying at that low point. As I said, I think price scares some, but that's going away. They realize in some cases it might be a high price, but it's a fair price. I think the confusion over different policies and coverages is some, and that's one of the things Matt does. He goes out and tries to explain to people the differences of these things. So there's an education matter here, and we'll save that for the conversation. So I was asked by a number of people to try to put to bed some, or maybe not dispel, but explain away some frequently heard misconceptions in Washington, D.C. about alternative insurance models. I will not discuss the hybrid approach of the Affordable Care Act. I think everyone can get their fill of that on their own. There are pros and cons to that approach, certainly. TRIA is often mentioned, and that's the Terrorism Risk Insurance Act. It's mentioned in the same breath as cyber. It's mentioned as an analogy. Let me just say two things on TRIA. First, it is a backstop. It is a substitute for a reinsurance market that vanished after fulfilling its obligations post-2001. By 2002, after the reinsurers had honored their treaties with their carriers, they entered into negotiations in the following year in 2002 and said, we're not going to cover your insurance company exposure anymore, and they walked away. The insurance industry, through a number of hiccups and regulatory reasons and other purposes, stayed for a little bit longer but quickly left thereafter. And what we don't want to see is that happen to cyber. That does not mean that we need a federal government backstop with, in my opinion, federal taxpayer dollars. It's up for reauthorization. It's coming, I guess, in 2014, December 31st, 2014. There are big pushes for it to be reauthorized. I understand the calls for that. It's a difficult thing in the insurance world if you've got that uncertainty facing you. However, I would assert two things. First, the cyber industry knows, I think, with a little bit more clear-eyed vision, what stands in front of them in terms of cyber potential losses than we did previously when we thought of terrorism before 9/11 as a hijack or a 3 or 4 person or a small, violent but small consequential event. And lastly, this kind of linear extrapolation of future data from current historical information is not something that we're going to get wrong in cyber. And as a result, I believe the insurance industries are healthy, they've got money, and the reinsurers are healthy, and that they have the wherewithal to reinsure against cyber. If we reauthorize TRIA for terrorism and expand its scope to cover cyber, I think that's a mistake. But that's my 2 cents. I want people to understand what it is. It's a reinsurance backstop. It's not insurance. It's not government-sponsored insurance. And the relationship between the government and the insurance companies is formulaic. So as to replace the kind of treaty-style agreements between reinsurers, it's a formula agreement. The second one that we hear, and I will not run you through this, due to perhaps lack of time, but also wanting to get a lot of thoughts on paper, I ran through quite a bit on flood insurance. That's the preview. Okay. Flood insurance is the only, to my knowledge, single-payer insurance system in existence in the United States. We've talked about single-payer in the healthcare debate. The federal government is the only provider of flood insurance in the United States. You may buy your policy from a broker. There's a public-private partnership that's healthy. But at the end of the day, the standard flood insurance policy is a federal document. The underwriter is the federal government, and it's administered by FEMA. Your policy coverages are set by the government and so on. Your premiums are, in some cases, collected by insurance companies. It's also the only mandated insurance at this point. Now it's the second mandated insurance. So some people now have to buy health insurance before the Affordable Care Act. Flood insurance policies could be forced placed on people that bought their homes in high-risk flood zones. So the federal government has done 3 or 4 things here that the cyber industry and the cyber insurers have not and won't. First, they can make you buy flood insurance if you want to buy a house. Second, they can make you accept the terms of their coverage as opposed to it being voluntary. Third, they have decided, and I think this is probably one of the reasons the program has been mildly successful. You can determine when you read this on your own whether it's successful. They have decided that they've figured out a good way to mitigate the actual vulnerability. We don't have a commensurate issue or commensurate situation in cyber. If we had a silver bullet where we could say, if you build your networks above the base flood elevation and outside of the floodplain, then you will have a secure network. If we had such a thing, I think it would be maybe a policy to entertain a comparison to, but we don't, and I don't see one happening. And then lastly, of course, the secret to the flood insurance program success is its borrowing authority. It has unlimited borrowing authority into the federal treasury, which is like having the deepest, biggest pocketed reinsurer ever to exist with unlimited funds. at the full faith and credit of the United States taxpayer. So the flood insurance policy is successful, but it dips into periods of insolvency every 4 years and then works its way back out, and then occasionally has a massive claims season like the 2005 hurricane year where they had $20 billion in the hole and they'll never recoup that and they'll write it off and it'll just go into the loss column for the United States taxpayer. So those two things are often brought up and used and bandied about as solutions to cyber. I think they're probably not appropriate for cyber. And I'm going to wrap it up by saying that traditional insurance, and here, this slide is important. I contend that in terms of aggregating risk, not aggregating risk in terms of the larger scope of the Zurich effort that we have here, but in terms of this potential for a bad aggregation of risk through insurance, that we have a very vibrant market. We have such a vibrant market that I'm sure Matt and Catherine wish it wasn't so. Their competition is strong, but that hedges against unfit aggregation. It limits prices and it puts positive pressure on coverage limits. Because you don't want your competitor to take your clients or to have a better reputation for payouts. So for right now, the free market's working in cyber. It looks, all signs point to it continuing to work, and it's working in such a positive way that we see new market entrants as opposed to consolidation. So for right now, I'm happy to be a free market guy on the cyber insurance model. Jason's telling me to wrap up. I'm gonna direct you to trends and cautions here. Hopefully I don't offend anybody with trends and cautions, but I do think that insurance in this field has to be coupled with very careful, attentive approach to the customer's needs. And I think we're seeing more and more that for those of you in the room that handle mitigation and treatment of the vulnerability, that a strong partnership with an insurance carrier is an absolute must, because their insured want to be taken care of kind of from cradle to grave in this response world. They want to have coverage. They want somebody to help them work their way through an intrusion. They want to prevent it from happening again. And they want somebody to explain to them how all their different coverages and policies are working together so that they have all the different riders and so forth lined up that Matt alluded to earlier. If you don't have the technical side and the insurance side in the room at the same time, it's a very, very unenjoyable experience for customers. I think we all have some stories on that. With that, I thank you for your time. I thank you for your patience, and I'll stop talking.
Thank you, Tom. So this concludes our presentation part of the afternoon. We're going to move into a moderated question and answer panel. If you're watching online and following, please continue to text questions on #CyberWednesdays. We have a couple of really good questions that we're going to start off with. But first, I'd like to bring our panel up. Before I do that, I want to introduce our moderator for today. We have Dr. Greg Rattray, who is a senior fellow here at the Cyber Statecraft Initiative at the Atlantic Council. Greg, let's see here. Greg is a founding partner and chief executive officer at Delta Risk. Before that, he was 23 years at the Air Force, working on the National Security Council staff and working on the President's national strategy to secure cyberspace. Well, with that, I'd like to have you guys help me welcome our panelists to the stage. We're going to have a great question and answer session. Thank you.
Okay, Mike's, I can tell the mic's working. That's great. Afternoon, everybody. I'd like to get, I'm going to ask a few questions. I'm going to ask that the panelists try to keep the answers brief, because a lot of talk has come from the stage already. So I want to make sure we get the opportunity to engage both the audience here in the room. Jason's already told me there are people out there that have tweeted in questions. I mean, one of I think the forward-leaning things among many of the Atlantic Council initiative is their aggressive use of new media and technology. So we'll try to get a broader discussion going as well. So, we had really, a superb overview almost of the state of cyber insurance, right? How the people that underwrite insurance think about it, how the frontline brokers are thinking about what they can offer and what they can't offer, some of the real dynamics as where does cyber insurance fit in the overall mitigation strategy. one of the things that sort of I noted, and sort of as a theme for me in general, is while there was a lot of anecdotal evidence, though even Catherine, some survey data was mentioned, measurement is the challenge, right? If we could measure these risks better, insurers would be able to, take more of the risk transfer. So I just have a set of initial questions that have to do with how each of these, some of the things brought up in the presentation, how the organizations, or in Tom, in your case, I'm going to ask you the biggest picture question, so, which is what percentage of risk can be transferred to insurance. So you get to think longest because you have the hardest question.
I appreciate that.
So Catherine, for you, you mentioned a number of sort of risk factors, one of which Matt really did a good job of explaining what constitutes a good plan, is lack of a plan is risk, you sort of noted that, organizations see the IT, this largely as an IT problem, but that a whole of company approach would actually make it, they tend to perform better if they've got a broader set of stakeholders involved. And then you talked about social media, mobile and cloud as sort of emergent risk factors. When Zurich thinks about underwriting a policy, how do you take these things into account?
Yeah, it's a great question. So we're really in as efficient of a process as possible. We are trying to get a really good sense of, yes, a company's IT policies and procedures, and having those chief information security officers at the table is a really important part of the discussion. So we ask lots of technical questions around the technology, but we also think about the physical security of a space and what a company's network looks like that way, and then it's very much sort of getting a sense of a company's culture, their management philosophy. We look at the people. How are your people trained? How is that training re-upped? What's the overall philosophy around protecting data and keeping employees informed about what to do if there's a situation that's a potential problem, escalating concerns. So and we're trying to do that with the likes of Matt and our broker partners, getting that information in a time frame that's reasonable. So remembering that risk managers are dealing with many lines of insurance, we're trying to get lots of information in a very short amount of time.
A challenge.
Yeah.
Yep. So Matt, you brought up something that I think is a very large challenge. Just wanted to dive a little deeper in the thinking around it. So, insurance products exist. Data breach tends to be a focus for those products. You showed some ability to quantify sort of how to estimate losses from data breach. Then you highlighted, which is certainly front of mind for the field now, control systems and the fact that you could have attacks that cause outages for control systems. So as we start to think about insurance, how does one estimate the sort of lost business revenues? You all right, Catherine?
I have allergies. I'm very sorry.
It's okay. We'll work through it. Can we look at control system, attacks and actually insure against those? And because given what I think is probably a significant degree of uncertainty about how to estimate the losses that stem from those.
Thank you for the question. I think it's accurate that it's a more complex equation to estimate what the business interruption, revenue losses, and extra expenses are going to be. That being said, companies do have a history of what their revenues are, and they can picture scenarios that if there is a network interruption that creates a substantial outage, what their possible exposure could be. Usually there's a retention point that I would estimate somewhere, depending on the industry, there's going to have to be an outage of 8 to 12 hours before a business interruption coverage kicks in. So there needs to be somewhat of severe as opposed to just a temporary problem. But yeah, I think it's an equation of what the revenues are for that company, and that's really the exposure, and the company's going to gauge that by what they're seeing in their own systems. And I think that as this is becoming more and more complex, you're starting to see more security companies involved in the equation as well, that between the underwriter and the potential insured, there'll also be consultants, maybe even consultants on both sides from security companies who are providing recommendations and their evaluations.
Okay, thank you. And then, Tom, you really hit at the start of your presentation on the biggest picture. I think there may be almost universal acceptance of the notion that risk transfer through insurance is one of a set of mitigations, right? So as a policymaker, as we start to wrap our head around, the mix of mitigations that we want in cyberspace, how would you quantify how much can be transferred via, insurance versus good defenses versus, acceptance? Because as Matt highlighted, in his example, I think, some companies are just accepting risk because of the sort of costs and, lack of ability to calculate how to, the utility, the return on investment of, dealing with legacy systems. So there is a lot of acceptance out there. So in those three broad categories, if you have numbers, that would be great. But assuming that we don't have 33, 33, 33, how do we get to what the numbers are?
Yeah, 33, right? That's 39. Well, there's two answers, so that's a great question. I think the first answer, though, is the easiest, the one that you posed as maybe the most difficult. And that is whatever the market will bear. And I mean that very seriously, because buyers of policies are, to the extent that they buy, happy with the price and must remain so. But the providers of insurance, and they shouldn't be abashed about this, they should be wholly unabashed about this. The insurance carriers need to be profitable. And if they can figure out a way to meet in the middle and sell a policy that allows them to remain profitable and that covers the client in a price point that makes them happy and meets their needs in a loss sense, then we've got a perfect outcome. And you can mess with those variables to the extent that either side can afford it. You can cut into the profit margins on one side, you can increase or decrease the premium prices and coverage limits and exclusions and exceptions on the other side. But as long as we're able to reach a certain equilibrium in an agreement with fair knowledge, I mean, there's an asymmetric information system, problem here that Matt's alluding to. We've got a lot of technical folks on both sides of these discussions trying to figure out information, and we have an asymmetric situation where I'm not going to tell my insurance provider how bad my problems really are, or they're not going to sell me insurance, potentially if I were a bad actor and so forth. But the system works conceptually, and as much transfer as people can afford within a market-based system. When you talk about asymmetric information, that's the second half of your question. What happens when there are free riders, bad actors, you asked the moral hazard with somebody that decides to just not care. It becomes a problem of adverse selection, right? So what happens with asymmetric information? You either have adverse selection where only sick people get insurance, or only sick networks and bad managers and stewards of their data and their networks get cyber insurance, or you have a principal agent problem where the motivations of one are not the same as the motivations of the other, or lastly, you have this moral hazard. The answer is you don't have to have a perfect number. You just have to have a procedure, a process or a procedure for identifying and rooting those folks out. That was Catherine's question. That was Catherine's answer. She said, we spent a lot of time trying to figure out whether these are good people or not. That's really what she's saying. It's not just about what procedures they use, what tactics. They're asking as many questions as they can to find out if these are good eggs or bad eggs.
You did say the insurance underwriting process was mysterious, so I'd like to
that's right.
maintain that mystique here today.
That's right. I'm sorry for making that too plain. But no, don't take my remarks earlier as a criticism of the insurance industry. I think as a function of time, it's just a given that the process will become more mature.
But I'd like to add that, I think it's important to level set here about what insurance is available. Matt did a really great job of reviewing the scope of coverage right now, including where it came from, which was the technology E&O space. But when I think of the world of exposure, I often use what Richard Clark has sort of outlined as a model, which is these buckets of exposure: crime, hacktivism, espionage, and war. And only part of that is actually insurable at the moment. The nature of insurance is that not everything will be insurable all the time. So something like war, which is unpredictable and chaotic, and we don't have the ability to get actuarial data behind how to price risk or set limits or capacity. That's generally something uninsurable, but in this space, we have these other emerging items like cloud that I think, the likes of Marsh and Zurich and others in the insurance space will be trying to figure out products to address those exposures. So it's still kind of emerging.
Yeah, I think what I take away from this is that, Tom, I think your fundamental point, we should be happy that insurance can provide what it can provide. Given the relative immaturity of measurement and the fast pace of technology, and I'm going to let go to the audience, the fact that threats actually bleed quickly across state levels into criminal levels, which will also make it challenging for insurance. So there's an embedded question in that going forward. That right now we can't transfer a ton this way, but the industry is working hard on being able to, in a win-win way, transfer as much as possible. So with that,
and to go on that point, just add, if you want to encourage the ability to be able to transfer, so as you said, the cyber coverage had grown out of a tech E&O policy, and professional liability policies, E&O policies, excluded under TRIA. But to revisit Tom's point during his comments on TRIA, so I worked with Tom and for Tom at the Homeland Security Council, and Tom is brilliant. The only flaw of Tom is that sometimes he wouldn't ask my opinion, and then his conclusions would be dead wrong. TRIA should absolutely cover cyber as a peril as its potential to cause property damage. Otherwise, you might run into another 9/11 type situation where you have an extensive cyber attack that is causing massive property damage, and insurers pay off, and then they say, we're out. And then you're going to have another government response and say, okay, wait a second. Cyber should have been included as a peril, so now we'll set up a cyber TRIA. It makes no sense. If it's a terrorism peril, then TRIA should respond to it on a property side, on a workers' compensation side.
Not to address that yet, but there's two thoughts here that, Greg, are important. So the first is threat. So Catherine raises this bucket issue. I like it. I tend to talk about malefactors. They're not criminals. I say malefactors, people with some bad intent or bad aim, I guess. The reason I say that is because they're not all criminals, right? We've got state actors. So I talked about threat being people on purpose. And that's one thing that I said right up front the government's going to have to take care of. Imagine if we had a completely lawless environment where criminals were allowed to run rampant and there was absolute chaos, and then said, how do we handle this through a combination of insurance and security? Well, locks on our doors and windows and so forth, that kind of mitigative security. And the answer would be, wait, there's something missing. You need a third element here. You need to address that threat piece. And if the government can't figure a way out to do that, I know there's problems inherent here about borders and so forth, then we're really never going to fully address the problem. That's why insurance is just a part of it, not a solution. But the key word to Matt's point was opinion.
I think we'll end up getting
Some
back
are right
to...
and some are wrong.
Right. Agreed.
And we have a lot of opinions, and we need to get some of those in. So I'm going to actually Jason, I'm going to work my way to you in the Twitter comments, but from the back to the front in the back row.
Sir, yes, thank you. I'm Jeff Sarnacki with Publius LLC, and I wanted to talk about that juxtaposition you talked about, Matt, between insurance and the insured, and overlay my role, and that's that security consulting piece, to specifically address that the extortion, data extortion, where most of these other lines of insurance and risk are sort of secondary or tertiary effects of the malevolent actor or the malefactor behavior, whether it's a cyber attack that has cascading effects, where the cyber extortion is, I'm going to hold your data, whoever you may be, Verizon or Professor, your class records are now about to be deleted in 5, 4, 3, 2. What are you going to do? And what I guess I'm wondering is, do we not run the risk of establishing what that costs to get your data back by an insurance? And that's as I talk to clients and you say, what do I insure it for? Well, whatever you insure it for, that's going to be the cost of that. Where everything else is sort of, we'll see how that is. So I guess my question is that a reasonable policy to purchase, or are we just kind of setting the bar for what that loss is going to be?
So just so you know, Jeff is a familiar face to both Tom and I, and also worked with us on the Homeland Security Council and knows what he's talking about, a former FBI special agent and ATF agent and accountant. So, so it's an excellent question, and I will say that cyber extortion is one component of a suite of coverages that are taken in, and whether it's something that we can reasonably expect to. I mean, the problem with cyber extortion is it's difficult to pull off without attribution. You know, there was a 12-year-old Canadian hacker who was able to get great entry into some government systems. The problem is he eventually got caught. You know, hacking's one thing and getting away with it's another. So for the policy coverage, I mean, I think that it's viewed as a low probability, and therefore, just from my experience, it doesn't add a lot to your premiums because of its low probability, but it's a potential because we know that a system can be, for lack of better terminology, held hostage. And therefore, it's another protection that can be offered by underwriters such as Zurich.
Yeah, real life kidnap and ransom went through this, and it was almost not profitable for a while. I think Beasley's probably credited with being one of those that married the insurance with the security practices in a way that was more reasonable and probably increased their premiums in a way that said we're either going to be profitable or this is all going to go out of business, and people had to deal with that reality. So the first thing to do is to charge higher premiums than maybe you're conceiving of when you ask that question. And I think the second is that insurance is a positive force here, because a lot of what we saw pre-insurance on this cyber extortion was not only give me money, but don't tell anybody about this happening. You got to keep it anonymous. And now, if you want your insurance money, you've got to report it. In fact, it's a mandatory reporting requirement in your policy, and law enforcement's moving to that as well, saying in a regulatory sense, depending on what sector you're in, you have to report. So I'm sorry, Mr. Extorter, I may pay you your money, and privately I've told clients to do it, just pay it. But I'm going to tell on you, and we're going to catch you, and that's what you used to do for a living. So I have a high degree of confidence.
Mill?
I'm a nurse. My name's Barbara Dello, and I'm a nurse. And my name's Barbara Dello. I'm a nurse, and I'm thinking about how this will affect with healthcare technology, and I'm thinking about some of the situations: psychological visits, family counseling or hospitalizations, family violence, AIDS or hepatitis, genetic diseases, prognoses, alcohol or drug-related things. We all have teenagers, and medical consequences of love triangles. And what I wonder is, does this go beyond, my question, I guess, is does this go beyond what insurance can fix in terms of harm to people's lives? And can it be used as a tool of political leverage or extortion for money or influence, or to destroy families and marriages?
Are we talking about cyberspace, basically, potentially having all those, bad effects, right? And then, I think it's really, in my opinion, maybe not much of an insurance question, because I don't think that, hopefully you guys can insure against some of that.
Well,
but
yeah, there's a couple of things to get at. So number one, the insurance policies will generally cover PHI, the personal health care information. So that's the healthcare records, and these guys probably know better than I do about what the cost of a healthcare record is compared to just a credit card number. It's like $2 on the black market for a credit card number and that information, whereas a healthcare record goes for $50. So that information being disclosed, lost, that can be picked up under these policies, and it's defined in the insurance policies. Some of the items that you mentioned will be protected under HIPAA to a higher degree, so they'll be subject to a higher degree of care of how it's protected. So those are some of the underwriting questions that we would get at in talking to a healthcare organization. But one of the things that you referenced at the end, if I'm understanding your question right, is, well, what if I have a mental illness that if it's disclosed, I'm concerned about reputational damage to me, say, for example, in the workplace. That's this concept of fear of future harm. So somebody stole my healthcare information, and now I'm afraid of how that could impact my reputation. I have heard from some of our privacy breach attorneys that we work with that they have seen some of these claims, so that's not a far-fetched scenario. But in terms of how they play out in the courts, that's another thing altogether, and that gets at the issue of we don't have good actuarial data because these claims are still open and evolving. But I think, Matt, you and I were on a panel where you were talking about that theory of fear of future harm has actually been tossed out recently, right? It wasn't a PHI issue in that case, but didn't you reference
there's
that?
a division amongst jurisdictions, but what you'll see for most cases that if you're not establishing financial damages at the prima facie stage, then it'll be subject to a motion to dismiss. And that's where most data breach cases fail because of the way that if you have a proper mitigation plan in place and you know that you have a notice, well, you do your notifications, you put in credit monitoring, and where there has been damage, you put in credit restoration. So then for the resulting class of individuals who have suffered a data breach, well, what's the real damage to them? And that's why it's so difficult to defeat the motion to dismiss stage. However, I would say, just going off the question, I mean, it did bring up a lot of the kind of sensitivities around healthcare institutions. And, you know, one of the things we have to think about is kind of the mobility of data that's being required in the healthcare space. You know, a single hospital or a single hospital organization that might have 12 separate member hospitals will have hundreds of applications with hundreds of interfaces that are required to speak to them. It just means that the data is being transferred more and more, and if you have a bad link in that chain, then there's a greater likelihood of some sort of data breach that could have these horrible consequences. And yeah, I think for Tom's point earlier on moral hazard, that it's not so much companies that are saying, well, I've got insurance, so I'm covered, I'm not going to take the extra step. I think that companies will buy insurance, but are also looking at their compliance requirements, that they're doing so much to keep up with their compliance requirements. Well, you know, how much extra do I have to go security? Do I even have the resources or the time to go that far actions? I think that's really the moral hazard. But I think that the overall theme of this is that it's growing increasingly complex, and we're really at a stage where it's just evolving. I mean, we've been talking about electronic medical records for decades now, but we're right at the cusp of where this is evolving into a truly electronic stage, and we should expect a period of pain as that evolves and develops.
I think I'm going to keep coming forward, and including to you, Jason, and then back, and then up to you, Randy. So, right here, you're next.
Thanks. Mark Frey, Steptoe & Johnson, and before Matt points it out, I also had the pleasure of working with a couple of folks up at the panel in a former life. Two somewhat related questions. One, I was a bit surprised during all three presentations, not particularly yours, Tom, not to hear anything about a Cyber Safety Act and whether or not that's a good idea and whether that's something that should be pursued. So I'd appreciate the panel's thoughts on that. And relatedly, with respect to the framework, there was a bit of talk about the DHS framework, what's going into it. Obviously, it's voluntary. There are a lot of incentives being proposed. One of those incentives is insurance. Is there a way, if folks comply with the framework, do they get reduced premiums, you know, akin to putting in a fire alarm in your house or something like that? Or perhaps if they choose certain certified technologies, they can also get a reduced premium. So I'd appreciate the panel's thoughts on, first, the Safety Act, and then secondly, where things may be going on the incentive side for the framework implementation.
I mean,
I'll go first. I'll go in reverse order.
and then I'll correct whatever's wrong with Tom's.
I'm not going to let you draw me into that TRIA. Let me commit a foul here in the Atlantic Council world and commend those in the audience to a Cato Institute paper on TRIA. It's a policy analysis. I think it's 736. It's good. And it lays out both sides of the argument that Matt and I are jokingly having here. You know, I get nervous anytime Congress starts to mess with liability protections, waiving them one way or the other. You know, you might think from my political persuasion that I would favor some of that. I understand some of the litigious kind of barriers to good entry into this market in terms of security, but I'm not a huge fan of the Safety Act right now. I think there's some issues with it I don't necessarily want to get into right now, but I didn't touch on it because it's a whole, for me, hour-long discussion and debate, and there are things I think need to be corrected that get me into a discussion that sounds an awful lot like a law school class. But what was the second question here? The second question on moral hazard?
No, incentives for adoption or use of the cybersecurity framework and where insurance fits in.
Yeah, it's funny that you ask. I'm here with my government and industry affairs guys today, and we were on the Hill today just talking about that. So I'd say that'll probably be an evolving issue, but here's some challenges to that. One thing is what I mentioned before, which is sort of where the insurance policies exist today and what they're covering, and that it also tracks with what customers are telling us they're concerned about, this reputational damage, protecting this information. So they're kind of going in this direction, and the insurance is saying, right, we'll follow with that. Whereas the framework is also only critical infrastructure companies. So, for example, I met with a cosmetics retailer last week, and he was very concerned about his security and privacy exposures, but I still have to deal with that from an insurance standpoint, and the NIST framework doesn't apply to him, right? Although he did jokingly say to me, what cosmetics aren't critical infrastructure, but in my life maybe, but that's the thing. So government, the framework is kind of going in the other direction and is saying, well, we're concerned about these macroeconomic issues, and justifiably so. They're important issues, but it's just, they're kind of going like this right now. Some of the other concerns would be that I talked about these buckets of exposure, and some of it just isn't insurable. So there's some things that we just probably won't figure out, and there are things that I think we're trying to figure out. So actually, I've had many conversations with Matt's colleague who specializes in utilities. And he and I have been working out the issues. I've been talking to my colleagues who deal with other types of insurance in the utility space. And we're trying to leverage all of this knowledge to say, well, how could this insurance potentially evolve for that universe? So some of it is still TBD. And then lastly, I would just leave you with the thought that, you know, there's the exposure levels. We already have a degree of baseline best practices that we think about and that we would credit or debit your insurance or price your insurance. I'm going to price a healthcare organization differently than maybe just a B2B manufacturer. There's kind of two different levels of exposure there. So it's hard for me to say I'm going to apply a credit across the board because every industry is going to have inherently just different exposures. So those are just some of the challenges, but I think it'll be more to follow.
If I can, to address the Safety Act question just a little bit, not that it hasn't been addressed, but I'm just going to answer a small piece of your question. I think that, well, I know that the DHS Safety Act office has already given designation to some cyber technologies. So we know that Safety Act protections can apply in the cyber arena. The question, you know, of whether if it's an act of terrorism. So the question is, you know, if you're going to do a Cyber Safety Act, are you expanding it beyond an act of terrorism? Well, I don't know what that looks like. So that's, you know, I would caution that the Safety Act had a very specific purpose for the unpredictable event of terrorism. So I would really want to proceed if you're going to expand it beyond that very carefully. However, I would say for an act of terrorism, to my knowledge, there's no requirement of identifying attribution, and that if there is an act of terrorism and you can tell from its consequences, you know, that it looks like an act of terrorism, then I think that the administration should be allowed to, it should be able to declare an act of terrorism under the Safety Act based on consequences.
One of the things I alluded to, I went to, again, New York via China when I hit flood insurance, but it's a useful comparison because there are literally building and zoning codes and ordinances that, if they're followed, have a measurable understandable, seeable, really, really obvious effect on your risk of flood. In the cyber world, the cynic would say the premiums of higher and lower aren't quite a science yet, and so how can you put a discount on something that's part art? I'm not quite there. I'm not that critical. But we're not nearly mature enough to start, as Catherine said, applying blanket, even sector-specific rates, I think, or rate reductions, because there's too much of an individual. This is something maybe the insurance guys will think I sound like a rookie on, but customization of policies doesn't happen in other fields very often, right? You don't come back and say, change your standard form. How often do you guys change a form in the life insurance side of your business? Probably 10, 20 years.
Right.
In cyber, I was talking to one of Catherine's colleagues up in New York at the Advising event, and he said, we're going to issue another form in 2 years. And we just issued one 2 years ago, and it's kind of like a big day for the insurance industry. So there's customization, I think they call it manuscripting. But then there's also new forms happening as we learn more on a regular basis. So it's just an immature industry, not an idea that's bad.
Jason, I'm going to go to Twitter.
Great. This actually follows really well from that conversation. It goes back to Catherine's presentation. It's 2 questions following on. First, what standards do insurance companies use to set their limits? And the follow-on to that, you're talking about insurable threats or risks and ones that are uninsurable. Do you see commercial espionage as an insurable risk going forward?
Excellent questions. Thank you. Twitter universe. I feel very modern. How to set limits? Well, that's something where this will be a little plug for Matt, where I would strongly encourage people considering buying this coverage to really engage with a broker who specializes in this space, because a good broker is going to have access to benchmarking data. So you can sit down with Matt and say, I'm in this industry segment, and other of your peers buy X amount of limits. So I think your broker partners can give you good advice on that. Another thing will just be, if you've done all the work around assessing your risk, where is the data, how much of it do you have, then you can start using some tools that many insurance carriers, including Zurich, will give you access to, like the eRisk Hub, that can help you calculate what the total cost of an event might be. So that's another thing. And then thirdly, I would also say to look to your contracts, because sometimes those contracts are going to require certain limits if you're engaging with a business partner. So those are some of the tools that I would say our customers use to sort of decide. Another thing would just be as simple as, some folks say, okay, I'm going to buy sort of that entry-level policy of a $10 million limit, and then in the future, I'm going to see about buying more limits. I don't know, Matt, do you have anything to add on the limits question? Or?
I would say that we do have benchmarking data that we segment by sector, by revenues, and I agree. I mean, I kind of alluded to this in my comments that our process with any prospect or client is primarily educational, because it is new space. So we go through an extensive process where we go through a cyber assessment on our own that somewhat reflects what we expect an underwriter to ask a company, and we try and go through what their practices are and have that discussion with them so that they can expect. And then part of that is also, we try and assess what their primary risks are, and we also go through the benchmarking. Take a look at what your peers are doing, which repeats what you just stated, but we have plenty of that data to divide it up by size of your company and by sector. So give me a call, by all means.
The next part of the question was about commercial espionage. So that's really just a fancy way of saying intellectual property. So intellectual property insurance coverage is notoriously thorny, just because it's such a challenging area in terms of valuation. There's the different elements of intellectual property. So what I will say is that the existing policies will cover if you have your customers' intellectual property in your care, custody, and control under a non-disclosure agreement, and that is breached, then you could have some coverage there for the liability arising out of the loss of your business partner's data. But I suspect that the question is actually asking about what about my own information, my own IP? What if that is stolen? And right now there is not a vehicle in the insurance realm for covering that. And a big part of that, I think it's something that we're probably going to have to, I'm looking at Matt because I think insurers and brokers will have to start wading into this, these murky waters, but the problem will be valuation, and IP cases are notoriously expensive to defend, and it just can be a really challenging proposition about how to do this coverage successfully. So I think more to follow on that case.
One more from Twitter, and then Randy, and I think there may be one more in the back, there.
Just a quick follow-on to that question, and then I have one question from Twitter. There was a tweet that came out when Tom was talking about consequences and threats, and it was quoting Tom, "In the United States, threats can come from government. Hashtag Snowden." You were talking about valuation of threats and not being able to value intellectual property threats. What about threats from government? And then the question that I wanted to ask from Twitter was, does the private sector play a role, I'm paraphrasing, does the private sector play a role in insurance specifically in creating mitigating factors? They were saying, they were using the example that was spoke about earlier with regards to lowering your premiums. How do I lower my premiums was the question.
Hopefully I said governments, plural, not government, suggesting the United States government. It was not a reference to Snowden, although that's a very damaging set of circumstances to our national security, but also to the general notion of trust in government. Other nations are doing it. There used to be a joke, it's not really funny anymore, that it's not a matter of whether the government's in your email networks, it's a matter of whose government. I think there's some misconceptions, and there's a lot of hot blood over this debate. So Snowden is kind of a hashtag I want to stay away from. But when I say government's plural, I mean to suggest that there are legitimate national security interests that people pursue within the government authorities that they operate under that distinguish them from the everyday commercial citizen. We're not allowed to hack back. If Dimitri's out there listening, we've had this debate publicly a lot. There's a lot of instinct among type A CEOs to say, I'm tired of being hacked. Hack them back. And we say, well, that's illegal. Well, the heck with it. You're not helping me. Hack them back. So there's a vigilante tendency. Stuart Baker has written on that. So there's a lot of people that have talked to that. So I don't want to talk too long on that, but I've really heard two questions here on the same issue of damages. On intellectual property, damages are very hard to figure out. Just because a copy of your data has been taken doesn't mean that you're suffering financial loss. And the first question we heard was from the healthcare question. And no, insurance and money can't fix all problems. Absolutely not. And there's reputational issues commercially and individually that just can't be fixed with money.
In terms of the question, how do I lower my premiums was the question. I mean, well, this actually...
The practical question.
The practical question. That something that Greg mentioned at the beginning was sort of alluding to this absence of data, and that is so true from an actuarial standpoint. So I'll reference the Net Diligence study that they've been doing the last few years. Net Diligence takes a look at covered insurance claims in the cyberspace, and what the 2013 study reported was that the average claim payout right now is $954,000. But most of the claims that they studied are still open. And so they're sort of projecting out that those will probably close out in the $3.5 million range in the next 2 or 3 years. So that's troubling from an insurer's standpoint, right? We like predictability. That helps us price things. So someone mentioned just the capacity that's available in the marketplace. That's an excellent point, because for buyers, that means there's available capacity at a pretty reasonable price. And I was talking to a risk manager a few months ago who said to me, well, the product seems expensive. And I said, but how do we know? We don't actually know. I mean, we're using the actuarial data that we have right now, and we're building rate models accordingly. But if we take the net diligence study as an example, these are what we call long tail lines, which means I don't know what my final dollar amount is going to be until a few years down the road, which means was that $100,000, for example, that I charged for that policy today, is that going to be a good deal for you or a good deal for me 10 years from now? It depends how the claims payouts evolve and how those cases settle. So I think that's something that we're still kind of waiting to see. What you can do now, I think, gets at what Tom's slide was pointing to in terms of the risk mitigation. Look at people, process, and technology, and how are you protecting that?
So we got, I think, a couple questions left. We got about 5 minutes. So I guess we'll go back there first. Question short, answer short. Then, Randy, you're going to get to close us out, I think.
My name is Martin Meiman from the Institute of International Finance. Thank you very much for those presentations, which were very insightful. I'm interested to know, there's a lot of discussion around data breach and all kind of the liability coverages on insurance. You mentioned as well a lot about critical infrastructure and kind of at the beginning, at the outset, cascading failures regarding cyber risks. Are there any thoughts from the panel regarding coverages which are affected at the moment on critical infrastructure and really kind of threat scenarios in that sense from critical infrastructure perspective, which I thought in the discussion was a bit less weighted than the data breach and kind of regarding hospitals and other sensitive data.
Yeah, that's the new part. So data breach we've got a better handle on. The new part here, to be colloquial, is all the other stuff, right? So the business interruption that we would see in a utility sense is going to have a cost. But there's a number of factors here that led us probably to not talk about it. I'd like to hear Catherine and Matt's view on this because they're much closer to it than I am. But from a policy perspective, I think the way the market is right now protecting itself, I'm pretty certain on this, is that they simply don't allow them to be set up with the potential that their whole book gets run through with third, fourth, fifth party damages or tertiary damages, right? So you don't say if your operations are out and you provide power, then everybody who has a business interruption because they lost power has a damage, and everybody that they served in the vendor line has a damage that they served, and they can all come back and sue against that policy. I think one of the reasons that insurance providers provide these limits and exclusions and exceptions is to prevent against that. In data breach, because we have our hands around it a little bit better and the costs associated with it, you do have these the kind of third party, these heartland type charges that are covered. But in business interruption, in continuity of business practice, I just don't see how the insurance companies could sleep at night covering these third tier effects. It just probably won't happen unless there are really, really high premiums. That's my guess.
Well,
Yeah, I mean, that was sort of the examples that I was giving of the utility companies that were starting to look at the business interruption. They're less concerned about the privacy issues and following those regulations. They're looking at the business interruption. So we're working through that.
So let me make sure I understand. So the utility loses 5 days worth of revenue, and that's their loss claim.
Due to a network breach.
Due to a network breach that causes a power generation problem. What about the guy that's plugged into his heart monitor, and he loses power and he dies? Trying to put it into simple terms, they're not going to be able to sue against that coverage.
No, the policy is not designed to cover physical loss or damage or bodily injury. It's covering financial damage.
Right. So same example, if now my company doesn't have power because your insured power generator doesn't provide me that power. Power is a bad example because most power contracts are interruptible. You don't have a non-interruptible power contract with your utility company. You can't sue them every time your power goes out for an hour, and those legal transfers of risk already are in place.
So, I mean, if you give the example of an interruption or typical exclusion is if, you know, you won't respond to claims by a third party that are provided by some contract,
Right.
So it's first party expenses. However, if I'm a business and I'm relying on whatever that service is, and I'm aware that that service can be disrupted, maybe I should be carrying my own contingent business interruption, and I should be insuring against my own revenues like that. And that's a much more quantifiable equation for the insurance carriers to cover as well, rather than take it from, okay, and who's everybody you service on a contract, and the third and fourth and fifth party claims, like you said, well, why should you feed it all back that way? Why don't we do it from all first party, and everybody realizes what their own revenue is making a decision of whether they're going to be covered on an insurance policy or not.
And by the way, that very thorny problem of this community responsibility to one another and dependencies globally and interdependencies is kind of the key thrust of the cyber Zurich effort as a whole. Not today, but that's something that a lot of smart guys are sitting around wrestling over, like Greg.
You good? Okay. All right. We're right at 5 o'clock. I wanted to have everybody both thank the panelists, but thank the audience itself for a robust dialogue. So thank you, everybody.
Thank you.
And I just wanted to thank the panel, thank Zurich, thank you for commenting at home, and remind you that the next Cyber Wednesday is going to be December 18th. We're going to be doing risks and resiliency of the electrical sector. So third Wednesday of the month, every third Wednesday of the month. And at this point, we'd like to invite you to stick around. We've got some wine and snacks. Welcome for our social event. So thank the panelists once again. Thank you.